Now it's 1 minute past 10, so I would like to welcome everybody to this second version of the Life Science Investor Partnering Conference. And as you have already seen, the topic of today's conference is the investor wants to meet us again. What now? The background, of course, is we have a great pipeline of companies in different stages. We are helping them throughout the year with both creating a good company pitch and also on creating good investor slide decks for investor meetings and gaining interest. But as I think most of us in the room also knows, is that if you actually gain investor interest, there will come another 2-3 pages with bullet point 10 writing with new questions that the investors would like to know. So the topics of today from different angles will be how do the investors look at this? How do some of the law firms that support transactions and deal making look at this? And we will also present a tool that is automating the collection of information that you need in different stages, all from the very early first interaction with an investor to later stages and all the way up to public listing. In the life science cluster, we have a goal of creating 5,000 new jobs within the life science industries within the end of 2023. That is, as I'm usually saying, both a very hairy goal and also not very ambitious. 5,000 jobs is a lot of jobs. It is, for instance, 5 times GE Healthcare, or it is 2,500 new startups with 2 people in each. The truth, of course, will be somewhere in between this. And we definitely also want these startups to become tomorrow's new GE Healthcares with jobs and value creation in Norway. To reach these goals, we are not just relying on the companies in the cluster and the cluster itself. Part of our job is also to show stakeholders and authorities what kind of great jobs and opportunities lies in the life sciences. If we compare ourselves to Denmark, they have actually 20 times higher exports from pharmaceutical production than Norway has. So that's one example on if we choose to take advantage of all the good science that we are actually producing, the opportunity is actually a lot larger than 5,000. The life science cluster also spans life science across industries, so it covers both health, marine, agricultural, and industrial areas. And we see a lot of synergies between these areas as well. And this is extremely exciting now in the days where we see industry shifts from large productions for single markets to more and more precision medicine, precision agriculture, etc. And the technology shifts needed are quite similar across markets also. We have approximately 90 members in the cluster today. They span everything from large international firms to firms on the market with products to startups. We also have quite a number of expert suppliers, CROs and CMOs in the cluster, and to build a good and interactive industry, we are very dependent also on the supplier part of the industry, which is extremely important in these areas. We also have universities, hospitals, institutes, and also investors as part of the cluster. So we have a very good ecosystem of different stakeholders. This is another way to map our company portfolio. In this map, we have picked out the approximately 35 out of the 55 companies in the cluster that are what we call in investable stages. On the x-axis, you can see that market launch is approximately on the middle, with companies in development stage on the left side and companies on the market on the right side. And on the y-axis, you have capital need. And you can look with different sets of glasses also to these company logos that are placed here. Just to be clear, also on the far right hand upper corner is Pharmac, which is not a company in investable stage. That is now part of International Zoetis, but it's a picture of what all of these companies can become if we both manage to help them get to the market with their products and also support them in being able to choose to put production for the world market in Norway, as Pharmac has done. So they have production facilities both at Kløfta, just north of Oslo, and in Overhalla, just north of Trondheim. So this is both value creating jobs, jobs with a high percentage of people with higher education, which is very competitive in Norway. And it's also a potential for creating jobs anywhere in Norway, not just around the major university cities, as the case is today with the R&D companies. The facilities for production could be, in principle, anywhere in the country. And GE Healthcare again is an example with their factory in Lindesnes, the southernmost municipality in Norway. In the conference, you have the different options, and you can see the entry screen on the left of this picture. And now I have I have gone to the breakout room tab. That is something you can do both in the break and try to go to the coffee machine for an informal chat. And after the sessions, you could also go to the management for hire and mentors, where there sit a couple of people that you can talk to. Try to envision that you're actually going to the coffee machine after the presentations and have some informal chats with the people sitting there. And the same on IPR and contracts, where there also will be someone to talk to. So if you're interested in any of these topics, try out the breakout rooms, which open for more informal discussions than these one-way webinars can give you. And of course, also, if you press the People tab, this is where you find the people that you can agree one-on-one meetings with throughout the day until 5 o'clock today. And on schedule, you will both find these program slots with the speakers and all your meetings that have been agreed. So if you have received meeting requests, please also go and accept those that you would like to meet, or decline if you see it's not relevant. And it's definitely not impolite to decline this kind of meetings. That just clears the schedule both for you and for the other party. I would also say a big thank you to our sponsors today. Without these, it would not have been possible to lift such a program with the partnering tool available for you also. Admin Control, they're speaking later today and will show you the tool for data room establishment. Bauer, we are very happy to have them with us today, this year also. They also supported our first investor meeting last year. And Back Bay Life Science Advisors, who joined the cluster as a member in December. They are an international partner that knows a lot about processes and expectations, both from investors and collaboration partners from the international view. And they are also on the program later today. we have an exciting program with both investors, as mentioned, and also other stakeholders that will give you their different views on the process from an investor is interested and until you have signed a capital increase. So with this, I would like to hand the word over to Øivind Enger. Øivind is heading our investment and capital group in the cluster, together with Jonas Hallén from ARCS, who will also tell a bit about the story from the company perspective later, and also Susanne Stoffers from P53. But now, Øivind, I look forward to hearing your views on the program, and the stage is yours.
Thank you, Hanne Mette. I'm trying to share the screen, but I'm locked from it because you are sharing.
And I will stop sharing my screen, and now it's available.
Thank you. Thank you. So, do you see my screen now? Hopefully you can see it.
Yes.
I will try to take you briefly through the investment process and discuss very briefly, very high level, what the different stages in the investment process, or in a possible investment process, what the different stages look like, and what happens in the different stages. That's kind of like a backdrop to today's meeting, and also to later meetings arranged by the cluster on these topics. So there we are. Just a few words about who I am and who we are in Sarsia. Sarsia is managing 2 funds. We have one fund that is closed for new investments and is under realization, where we're trying to realize the portfolio. We have invested 400 million NOK in that fund, and we have so far realized, we've been happy to realize, or lucky, you might say, to realize 600 million NOK, and the total value of the portfolio is about 1 billion NOK, and the total portfolio is 22 companies. Currently, we are investing from our second fund. We are 4 years down the line in that fund. The fund has a total capital of 510 million NOK, and they are brought in by or through 3 different closings. So far, we have a portfolio of 11 companies, and we have invested approximately 100 million Norwegian kroner in those 11 companies. We are investing both in technology, the technology and renewable sector, and in life science. We have 5 companies in the technology renewable portfolio and 6 companies in the life science portfolio. The current valuation of our portfolio is 150 million NOK, and we have 8 more years to go in this fund. So that's very briefly what we're doing and who we are. I will try to take you through a very brief and kind of helicopter perspective voyage through the investment process, from the first sweet meeting and until payment of the first injection in the company. I think I will go straight into that. And I have to repeat, this is only one of several possible ways to do it. But this is the way we normally see it done in our environment. And we talk about early investments here, and we talk about maybe the first investor in the company, how this process happens. The first meeting, we covered that some time ago in this cluster in a similar seminar. But to repeat, there's a lot of peace, not peace, but peace in that first meeting. The investor wants to know what's the problem to be solved. What is the product to solve this problem? What patents does the company have? What people are involved from the company? How is the production? How will the production happen? What possibilities do they have in a market? What are the potential in this market? What are the plans the company has or would have to reach the market? Who are the possible partners that the company may engage in this process? And finally, the proceeds that the investor injects, how does the company plan to use those proceeds? And that last point is a very important point. That's maybe the most interesting point at this very early stage. So, and then the theme of today is the second meeting, and maybe the third meeting, the fourth meeting, the fifth, the sixth, seventh, eighth, ninth, and there might be a lot of meetings. So it's not typically one meeting and then the second meeting and then the money runs into your account. That's not how it happens. It might be a lot of meetings with the investors, between the investors and the company. But typically, in the second meeting, the investor would like to see a detailed plan with milestones and time and costs to reach each of these milestones, if that hasn't been covered in the first meeting. If it has been covered in the first meeting, the investors would like to see it again in the second meeting and to discuss it. And then the investor would typically like to see details about intellectual property, the focus of the intellectual property, of patents, the status, freedom to operate issues, and what geographies are covered by the IP. And then you would expect a discussion on valuation. Valuation is such a huge issue, and I think we will come back to that in a later seminar in this series. The investor would also like to see market details. Who are the players in the market? How big are they? And are any of those players possible exit candidates that can buy the company or invest in the company at the latest stage? And the investor would also like to hear if you have talked to other investors and maybe if a consortium could be established. So, and then after all these meetings, the investor would normally go back and make a decision. And if the investment decision is positive, then you would have to clarify what would be the investors' expectations for the corporation, for the corporations, and then what are the terms for a possible investment, and is there a possibility still for a consortium? So a positive decision is not the same as an investment. That's important to remember. It's kind of the beginning of a more serious process. And then if the thumb is down, you would like to have a discussion with the investor. Why did the investor reach a negative decision? What now? Is it something that could be fixed, and so we could come back and talk to the investor again, and maybe at a later stage reach another solution or another decision, and what will be needed to reach a positive decision, and then also would the investor have any advice on what you could do, other investors to talk to, other ways to go. We very often end up when we say sorry pal to a company, advising them for how to attract soft money from the Research Council or from Innovation Norway, and there are quite a lot of different systems there where you can attract soft money. So why would investors say no? There are a lot of reasons. There are, I think, as many reasons as there are investors, and you might be outside the field for this specific investor. You might be outside the phase that this investor normally invests in. The investor might evaluate the risk to be too high or the return too low, or maybe both. The valuation might be wrong, and as I said, valuation is very important, and we will come back to that. The investor might not be happy with the people involved, or the IP might be wrong, or the cost and time to market might be outside the scope of the investor. And finally, most important is the investor's own portfolio. Investors like to have a balanced portfolio, both with respect to face the different phases of the portfolio companies, but also themes or fields. So it might be all due to the investor's own perspective on himself and his portfolio. So I think that's important to bear in mind, that it is not necessarily something wrong with you or your company or your product. It might be that it doesn't fit in the investor's portfolio at the moment. If you reach a yes from the investor would normally go start a very thorough due diligence process, and you will have lawyers looking at all the agreements in the company. You will have IP specialists, patent attorneys looking at your IP. You would have regulatory experts looking at your regulatory or your plan on how to handle the regulatory issues. You would have experts looking at your technology, and you would have maybe be asked to show a market analysis from a third party, and all of this is extremely expensive, and you might end up in a discussion with the investor who pays for the due diligence party, because it's a quite expensive party, and there are different ways of handling that, but you should necessarily expect the investor to pay for all of it. And then finally, when you are through with the due diligence process, you might, if that turns out positive, you might end up with a positive final decision from the investor to invest in your company. And what you would need then is you would need a board protocol that advises the General Assembly to kind of accept an injection. There are a lot of ways of doing that. It could be through loans, it could be through share issues or other ways. But you would need that GA protocol, allowing new investors to come in and new shares to be issued or a loan to be taken. You would normally need an investment agreement with the investor, and always a shareholder agreement with the investor. And then you might finally see the money on your account. And then you would have to cope with that investor for a very long time, and hopefully you will have a nice and fruitful cooperation from that point. So good luck. Thank you. Mm-hmm.
Hanne Mette, du på mute.
Sorry about that. Then we are moving over to the second speaker in the program. This is Maren Bauer from Fynd Ocean Ventures. She is managing partner and founder. And the topic of Maren's talk is From Interest to Ink. So Maren, thanks a lot for sharing your insights with us, and the stage is yours.
Thank you, Hanne Mette. Thank you for the invitation. Let me share my screen. Good. So the Fynd Ocean Ventures, our focus is investing into ocean tech companies. And the ocean, as we know, is vital for a healthy planet, healthy people, and it can play a vital role in providing solutions for some of the major challenges we are facing. Feeding a growing population, contributing to solving climate change, diversity loss, and also creating decent jobs. Over the past years, I have been actively involved in this space, first through setting up Catapult Ocean, an accelerated program and seed fund focused on the sustainable blue economy and investing into 22 early stage startups. And now, since last year, setting up Fynd Ocean Ventures, a venture growth fund focused on this. And our ambition is to play an important role in driving this blue shift. We invest into ocean ventures in Europe, and we want to take an active role and support these companies hands-on. Short, just our investment areas are smart, sustainable aquaculture suppliers and the future of ocean resources and foods. So just to mention some examples, it could be about improving fish welfare, or improving the welfare of the surrounding ocean ecosystems around fish farms. It could be sustainable feed, plant-based and cell-based seafood, new applications of microalgae, macroalgae, and also residual material from the seafood sector. We've put together a very strong team, complementary team that have both experience from investments and working hands-on as owners, but also from value creation and deep sector competence. So this is important when we have an active portfolio to leverage our big ecosystem to support these companies in the best possible way. And we have a good network to attract deal flow, but also a network that we can use to support our portfolio companies. Impact is at the heart of all we do. So that's also an important thing when we assess potential investments. We do a thorough impact screening and sustainability screening. And the companies we end up investing in will also have to work actively on these topics and report this back to us in addition to financial numbers. We want to work hands-on, be an active owner investor, and that's also important, I think, when you look for your investors to really understand the approach and the way of working that your investors, potential investors, want to have, what type of relationship they want to have with the investors. And I think for most young companies, it's good to have at least a couple of investors on board that can really be an extended part of your team and your ecosystem, and I can work hands-on. But to make that work in the best possible way, of course, chemistry and these personal relationships are vital. So you've met with us in Fynd, and we want to meet you again. What can you expect? I think, as Sarsia highlighted, that process is, I think a lot of it is probably pretty similar between different funds. But I would like to now go through, okay, what does our process look like, and what are key topics we would like to dive into. A process is like this. We spend a lot of time meeting startups, mentoring startups, and we get recommendations from startups we should look at. We also do the same and recommend other startups to talk with other funds. So this is kind of the origination part of it. And then we have the first assessment of a company, and that can be even before we have a proper meeting to see, is this a company we would like to meet or not? And we have some high-level criteria we use. We'll get back to that more in detail. And then we start to dive into the companies. And at some point in that deep dive, if we find the company interesting enough, we will then kick off a formal due diligence process. And the timeline here from a first meeting to a final investment decision might, of course, vary. We like to establish good relationships with companies and follow companies, but we can do this process in, if needed, we can do that in maybe a four-week time frame. And after our due diligence, in this DD process, we have a two-stage IC process. So we will discuss this in our investment committee a couple of times. And after a positive outcome from a due diligence process, it's also about the deal closing, agreeing on terms and kind of all technicalities in the shareholder agreement and so on before the final investment is actually done. And throughout this whole process, you as a company will probably meet with several people, both, of course, the partner group in Fynd, but also our extended network of advisors that we use for different topics. So what do we look for? I think, these are some topics these are the topics we focus on, and we will dive into each one of these kind of in more and more detail through the process. The first one is there a significant underlying market? And is the company showing good revenue traction or at least pilot traction? It's an important part. And here it would be, as a company, you should have all these numbers and estimates lined up. And the more you can also here rely on external sources in addition to your own estimates, that's a good thing for us. Then the business model. Do we believe that, be very clear about how do you sell your product? What's your business model? And show that there's a clear path to profitability. And for us in Fynd, it's important that we look at scalable. We want to invest in companies that has high scalability. So please show us that you're first solving a real problem and that this solution is scalable. And then the team, of course, it's extremely important. I'll get a bit more back to that, but we dive into the backgrounds of the team. We do reference checks, and we want to understand, do we think we can have being an investor in such a company, it's a long-term partnership. Do we think we can work well with these founders over the coming years? Are they coachable? Are they able to attract the talent they need to continue to build their organization, and so on? Impact is important for us. We will invest in companies that have positive impact on ocean or coastal communities. So if you meet with us, we would expect that you have thought about the impact part of your business, and that it maybe already started to think about how to quantify such an impact. Of course, we'll look at external recognition, previous cap raises. We will develop our perspective on what our exit strategies and what could be the next home and next owner of this company. And we like that the management teams in these companies also have thought about that. Ownership structure is also, of course, important, and then match with Fynd. Do we think that we in Fynd can really contribute in the best, in a good way to this company? We also like if the management teams have thought about what do they expect and need of support from the investors that they are in dialogue with. And we will cover, this in increasing depth throughout our entire process. So we move on to, we've started to dive into these topics, and then we start our strategic due diligence process, where we go into these topics in detail. And I would just like to highlight, highlight some elements here. Of course, the target attractiveness here is vital. The team, the solution you have, the IP. Do we really believe that this solution is wanted from the customers, and do we think this is, this company is able to scale? In addition, the business plan and valuation here, we'll dive into that also. What's the historic performance of the company, and what are the plans going forward? Of course, most companies we meet, they have pretty ambitious plans, which is great, and you have to have that as a startup founder. But it has to still be sense checked, and I think showing how you're going to use the proceeds, the capital you raise, connect, link it to clear milestones going forward. That's vital. And then the organization and team, of course. Do we think this team, the current team, are able to take this company forward? And if not, there might be some solutions there, of course, as well. We can support to help build out the team, to find new key roles and so on. But then we need to make sure that the founders and those teams understand the need to strengthen their organization and are actually open to have such discussions. So, after going through this and all the business fundamentals, it very often ends up with the team, and we really need to feel like we've developed a good relationship with the team. We need to see that you as a founder are open and honest with us with what are your weak spots, where do you need support. We need to see that we as Fynd, as an investor, can actually contribute also. So do not be afraid of really showing your ugly side and where you need support. We want to understand, why are you doing this? What is driving you? Do you have the grit to take this to the next level? There's going to be a lot of ups and downs in building a company. We need to understand that the team, in really challenging times, that the team can still continue to work well together and just solve problems and challenges ahead. And are you coachable, open to advice, and are you nice to work with? Do we envision a fruitful partnership as actually a relationship between an investor and a company is going forward? And then we also appreciate a well-structured data room. Makes our due diligence process more efficient, and you don't need to use expensive tools. You can also use Google Docs, for example, to provide that information. Thank you. That was what I wanted to share.
Next speaker is Jonas Hallén from Arx Therapeutics. Jonas is Chief Medical Officer and co-founder of the company. And the title is Investor Meetings, Reflections from an Early Stage Biotech Company. And we are very happy to have you here today, Jonas. The company was established, I think, February, approximately 1 year from now, and you have a very exciting story to tell. So the stage is yours.
Okay, thank you. Let me see if I can share my screen. Can you see my screen?
Yes, we can.
Perfect. So thank you. Let me just say that, I don't have any illusions about knowing what investors think. So, but I do have experience from raising money for a startup company and from interacting with investors and running a biotech company now for the last 1.5 years. So this is not going to be a very structured introduction to the process, but more a collection of thoughts and perspectives that we've learned over the last few years, actually. So very briefly about Arx. We're a small Norwegian-Danish company, and we're looking to develop novel drug meant to address chronic inflammation and non-resolving tissue fibrosis. We're still in preclinical stage, which means we have not yet started to test our potential therapy in patients. And we have offices in Oslo at Share Lab and in Copenhagen, where we also have a lab set up. So, our story very shortly is that about 4 years ago, me and a colleague of mine were a little bit bored, I guess you could say, with our jobs in a big pharma company. And we were dreaming about starting our own biotech company. And then in 2017, we were started to look at some academic research that was done by a Danish group that actually came from a cancer research. But we then developed this idea where we thought this could have potential as a transformative therapy for patients with fibrosis. And in the fairy tale version, as you can see, things went very smoothly. We met with investors, the shoe fit perfectly, and we got funded. But the reality, however, was very different. We felt like we spent at least 2 years in the wilderness. The idea was not really developed at first, so it was quite crude. We spent a lot of time refining it. We read a lot of literature. We had lots of investor meetings, and we struggled initially to get traction. And sometimes even when we thought or felt that we had traction, we found ourselves back to square one again. So it took a lot of persistence and a lot of ups and downs, but we did actually then secure funding in 2019 after at least a couple of years. So first lesson for us was persistence and to never give up. And then when you think about walking into an investor meeting, I think you have to accept the reality that unless you have a very stellar track record or several successful companies on your CV, the investors will probably at first look at you like that guy on the left playing in the DC Metro. So it doesn't really matter if your idea is world-class if the investors do not know you. And in this picture, actually, the musician was world-class. He just performed at Carnegie Hall a few days prior to this. And this was actually an experiment to test whether people or humans are able to recognize beauty or skill or potential outside of familiar surroundings. And the answer was definitely no. You know, his combined revenue for that hour he spent at the DC Metro was about $32, which is not even enough for, or very far from enough for even a cheap seat at Carnegie Hall. So I think the mindset you need to have as a startup company is you need to accept that you start from a humble place, but you want to convince the investors that you will someday be a superstar and that you will perform at Carnegie Hall and that they will get a piece of the action. So you want to move their perception from the left to the right. And as has already been covered, you know, what are the investors looking for? And there's a lot of granularity, obviously, a lot of details, but at the high level, it's not really rocket science. I think it's quite easy to define a few important verticals that are more or less generic across any business. They will obviously look at your idea. Is it patent protected? Is it really feasible? Is there a market there? And how do you look compared to potential competitors? And then the team, that's maybe the most important component in my experience, is does the team have the right motivation, the right skill set, sufficient experience to execute the plan? And is the plan realistic? You know, is it properly stress tested? What are the milestones, deliverables? And then obviously, very important question is, how do you plan to actually spend the money that you're asking for? So there are a lot of boxes to check for companies looking for funding, and I sometimes like to think of it in terms of what's called the Anna Karenina principle, where, you know, in Tolstoy's version, all happy families are alike, but every unhappy family is unhappy in its own particular way. So for our purposes, it's clear that, you know, every investment decision or a happy investor meeting is more or less the same, but things can go wrong for a number of different reasons, and you need to really be able to avoid all of those potential things that can go wrong. So it's definitely not easy, but I wanted to highlight one thing that I believe is at the core of making investment decisions, and it's something that has been very helpful for us to think about, both conceptually, but also on a more practical level. Because if you remove everything else from the equation, what I believe really is at the core of our business, it's risk management. And it's true, you could say, really for all businesses that's the case, but particularly I believe in the life sciences, and then even especially for drug development, because you know from the start that failure is not really only a possibility, it's more like the rule in this business. So you need to be prepared for failure, but it's also incredibly important how you manage your risk and that you do that properly. So you need to be able to identify risk, articulate the risk, and then test it or move forward and discharge of the risk. And this comes back to what the investors want, which I believe, if you reduce it really to just one sentence, is that they want the next dollar or krone or euro that they invest is at the lower risk than the previous krone they invested, right? So you need to show the investor that you have a plan for your risk management. And operationally, what I found very useful is to kind of disaggregate the risks that you face into smaller components, and then articulate hypotheses and then test them sequentially. And if the hypothesis checks out, then great, you have now converted risk to knowledge, and with that, the value of your company. And then if the experiment fails, if your hypothesis is not confirmed, then okay, you failed, but hopefully you've done that early and relatively cheaply. And that's an attractive proposition to investors. So if you look at the bottom picture, you would much rather be on the right-hand side than on the left-hand side, because on the right-hand side, you know, you've addressed and discharged a lot of risk prior to your major investments being done. But whereas on the left-hand side, when you need the large amounts of money, you still have a lot of residual risk. So you really would want to reduce your risk sequentially and as much as possible before you raise the big money. This is attractive for the investors, obviously, but it's also attractive for the current existing shareholders and owners, as you know, reduced risk translates into increased valuation, and so you're able to raise money at a more attractive valuation. Let's see. Yes, I just want to wrap up with more some tactical things that I've learned from investor meetings. So the investor wants to see you again. Well, that's great. Obviously, you told them something that they think or believe is interesting. Something has triggered their interest, and it's still, but it's still going to take a long time. You know, things take a lot of time, so you need to prepare for a long journey. And for that second meeting, the investors may want you to present particular aspects of your case, or they want you to present more or less the same case to a different audience. Maybe they have invited other people from the fund or advisors to the meetings to test your idea, and they probably will have a lot more specific questions. And my experience, just as a tactical observation, is that you want to really answer all the questions crisply and straight to the point. You know, don't speculate wildly or wander off into hypotheticals. That's not really a good place to be. And also very important to try to understand exactly what they want to know. Why are they asking this question? And then this is clearly a data-driven business, so it's always good to try to back up your answers with data points as much as possible. And then this concept of being strategically consistent, but also have some flexibility. So, you know, be confident in your own story and in your idea, and don't let one critical question throw you off balance, make you uncomfortable. But at the same time, you know, also have the confidence to show that you're open to adapt or take new information into account that may alter your analysis. And then last point on this page, very important, you know, learn when and how to close the door. Not literally, obviously, but sometimes or oftentimes the investors will reject you. So it's very important, even if you right there and then believe that they have done that for all the wrong reasons, that they are ignorant or even stupid, you know, don't burn any bridges. You probably will meet them again at a later point, and it's not a good idea to just go for this scorched earth tactic. Just be very polite and try to learn as much as possible from them on your way out. You know, why did they reject you? What are their thoughts around your business? And then move on. And then maybe you will meet them again later. And then the last point was that it's also the second meeting or the subsequent meetings are opportunities for you to do your own due diligence, which is also important because it definitely is a long-term relationship. At least that's what you want it to be. And it's important that you gel well with the investors, because if you do not do that, then it's not going to be a very comfortable journey. So ask them about their investment process, ask them about, you know, the time horizons, what are the potential exits that they envision, what can they contribute to your company other than funds? Do they have particular experience or networks that you can benefit from? And what is their ability to follow up? Do they have dry powder? Because at a certain point, you're probably going to need more funds. So it's important that they are accept this and understand this, and that they are able to follow up later. And then what are their potential co-investors? Do they have people they usually invest with, etc.? So a lot of questions. So take the opportunity to ask them questions as well. And I think with that, I'm done. Thanks, and you can always reach out to me if you have any questions. I'm usually at ShareLab, or you can reach me on my email. And thank you.
Thanks a lot, Jonas. These were very interesting reflections, and I think you were quite polite when you said that you don't have too much information from what an investor asks. your experiences over the last year definitely has interest for other companies following you also. And I think your advice on doing your own due diligence and think about and reflect why you want exactly this investor on board. That is something that is increasingly important also for you as a company. So by that, we're moving over to the next speaker, which is also one of the sector investors. Ingrid Teigland Akai from Hayden Ventures, your managing partner and founder. And the very simple but tricky question is then, what is an investor looking for? So Ingrid, the stage is yours.
Good. Thank you very much. Can you hear me all right?
Yes, we can.
Great. Yeah, thank you, Hanne, Mette. It's great to be here virtually and take part in this in the seminar. Just to start off, I must say that a lot of the points that Jonas just talked about really resonates, and I think he has some really good reflections on how to interact with investors, and I'll talk a little bit more about that as well. I'll start out with just talking a little bit about Hayden Ventures, who we are and what we do, what we focus on, and then just narrow down sort of more specifically when we and probably most other specialist investors look at opportunities, exactly what are we focusing on. So I will share my screen. Can everybody see that?
Yes, we can see
now. Okay, very good. So yeah, just thank you, Mette. You give a brief introduction. As you mentioned, I'm founder and managing partner of Hayden Ventures. I have a background as a medical doctor, but I've spent the last 10 plus years working in venture capital, investing in startup companies within the life science space. Hayden Ventures is a European life science VC fund manager. So we invest in startup companies in life science space across Europe, a little bit outside of Europe as well. But we have a particular focus on the Nordics, where we see great potential in the opportunities coming out of here. We are investing from our first fund currently, which is a roughly 85 million euro fund. And that is the first fund of Hayden Ventures. But the investment team is quite experienced. The partners have worked together for many years, also before Hayden Ventures. We have our headquarters in Oslo, and this is also where most of our people are based. But we also have an office in Stockholm at the Karolinska Science Park. You can see the pictures there. We have an investment team of 8 people, and all of us have a very specialist life science background, either from scientific research. We've done PhDs, postdocs, or from clinical medicine as medical doctors, and some of us have done both as well. And in addition to that, obviously, we have more commercial experience and many years of investing in the sector. It's also a very international team. You can see on the right-hand side there some of the nationalities and languages spoken. We also have, in addition to the investment team, we have a back office that makes sure that our operations are running smoothly, which is critical for our business. So just briefly on what venture capital firm is doing. So as mentioned, you all know that we invest in companies, but where does that money come from? Well, when we set up a new venture fund, we have to do, as all startups are doing, we have to go and fundraise for that fund. Typically, where we find our investors is often at large financial institutions, and often this is capital that otherwise would not have been invested into startup companies. So it's a way that many of these institutions are basically channeling capital into innovation and startup companies. we create our strategy, which is based on two things. It's based on where we see the highest potential opportunities in the life science space, and also combined where we see we have our strengths as a team. So that's important, that we can make the best assessments where we think we are strong. So that sort of shapes our strategy. And when we have created that strategy, our job is to then to go out and find the best investment opportunities that fit this strategy. That is sort of a job that, you know, we go out broad, and then we sort of focus mostly on where we think sort of is the best fit with our fund and our strategy. And when we have invested into the companies, we work very closely with the management teams to help them become as successful as they can in the shortest possible times. It's sort of an intense working relationship. And then the idea is to get, you know, high potential, high return outcomes, so that we can return that capital to our investors, so that they are happy to continue to invest into funds like ours for our next funds. So that's the cycle of a venture fund. Just briefly on why we and others should pay attention to the healthcare sector, and I'm sure I'm you know, you're probably quite familiar to this fact. You know, everybody in the healthcare sector is these days that we are standing in front of a global aging population, which will have an impact on healthcare going forward. You can see the development of aging here in this graph, and we all know that aging is bad for health. Age is a key risk factor for almost all large chronic diseases. So this is a challenge that innovation is going to have to help us with. In terms of the breakdown of the global healthcare sector, you see here sort of the split between pharma, biotech, medtech, imaging, diagnostics, and healthcare IT. And basically the takeaway here is that, you know, these are very large sectors, and they are growing. So lots of potential. Just briefly on the stage that we invest into, we're a typical venture fund. That means that we are focused on what we see as sort of the typical venture stage, which is very much in the clinical development stage of companies. As of now, I think all of our companies are in clinical trials or just about to go into clinical trials. So that's really sort of the core focus on where we invest, which means that, you know, we typically don't get involved in the very early stages of research and preclinical development. That is typical stages where other investors and funding sources are more involved, like soft funding, seed stage investors, angels, etc. And then we typically are sort of before the stage where companies are mature enough to tap into the public markets. As I mentioned earlier, we are pan-European, but we have a particular focus on the Nordics, where we see high potential, and that is based on you know, high spending, high focus on innovation, investment in the basic research across the region. So we have really world-leading research environments here in specific areas, and we also see a good output in terms of publications per capita, and that's sort of really in the leading position globally. And in addition, what we've seen is that the startup environments have grown a lot over the years. There's a much stronger focus on innovation and starting companies in the life science space, and we've seen the development of clusters and incubators, and obviously the life science cluster is a very good example of that. And that sort of encourages and makes it easier for people to start their companies, and that creates sort of a good foundation for investors such as us. So a very good investment opportunities environment in this region. At the same time, you know, there are, as of today, and this is a reason why we chose to base ourselves in Nordics, are relatively few specialist investors like us that are active here. We invest quite broadly across technologies, including in the pharma biotech space. This is Rasverin from one of our portfolio companies, OncoInvent. We invest into medical devices. This is a device picture from another portfolio company, Cardiomec, and diagnostics as well. This is SAG Diagnostics, a Swedish company, and also digital health. This illustration is from our Finnish digital health portfolio company. So we're quite broad in this space. This is a snapshot of our portfolio. It is two investments missing, so it's not 100% updated. The latest one has not yet been public, but there are a couple of more companies in 81 portfolio. We also saw the company Themis Bioscience was acquired by Merck last spring. When we invest into startup company, we very often invest together with other investors in syndicates, and depending on the situation, it can be local co-investors, or it could be global life science VC firms, European, also US investors, and this is a snapshot of various co-investors that we have today in our portfolio companies. And that is very important from the perspective that we diversify our investments by taking minority stakes and building these syndicates. And also, obviously, that means that from a company perspective, we can add not just the capital that we bring, but we often help setting up these syndicates and recruit other investors to the companies. So from that, just moving on a little bit to what we look for when we invest into a company, and it's very much, as I talked about earlier, about strategy. So in terms of what we choose to focus on, that has often less to do with what we see as the quality of the company, but it has often something to do with the stage of the company and development stage, and also the strategic fit with our focus. But just to go through a few things, what we do like or required to see when we look at opportunities, and this is something that it's good to address when you make presentations to investors. First of all is that we need to see an unmet medical need. That is obviously from an ethical perspective, this is really where we would like to invest to address this unmet medical need. But in addition to that, that is often also what is the commercial opportunity when it comes to investing in and generating a return. IP is very important. The investment amounts and the time periods are obviously very long, which means that when you get to the market, you need to have barriers to entry. You need to have proper IP protection. So that is a checkbox exercise. That's something that needs to be there. So that's important to show when you go and meet investors. We like short, and this is obviously very relative because most timelines are not very short when it comes to our industry, but it really varies when it comes to timelines, and we like to see relatively short timelines, and that is because we have what is called the closed-end funds, which means that we have a certain number of years to invest the money and generate returns before we need to return it to our investors. So based on that framework, we need to find the opportunities, the investment opportunities that fit with the fund setup. Competitive situation, we need to see that the companies are aware of what the competition is and can also present why this differentiates. markets must be big enough, and that needs to be broken down. Have you then made realistic assumption when it comes to the pricing you could get in the market, in combination with the volume, so the number of patients. So it's really worth spending time really understanding your market and what your actual market size is. Regulatory clarity is also something we like. There are development pathways sometimes that are a bit untraditional, and we are a bit conservative there. We like to see that somebody has done something previously in terms of walking up the regulatory pathway. When it comes to untraditional regulatory pathways, often it includes a lot of uncertainty, both in terms of whether it's going to be possible to execute or not, and also in terms of timelines. Clear USP, and that really goes back to the competitive situation. Managing capital requirements, yes, again, it is about getting to the goal. So it's important to have a realistic estimate of what the capital requirements are to get to a realistic time point. And then it's about making an assessment whether it's possible to get that syndicate together or not, because obviously if you don't, then you really run financing risk, and no matter how well you're doing, if you can't get the money to continue to finance the company, then it's not going to be possible to execute. Agile founders, and Jonas talked a little bit about this as well. It is really important to be able to react to the situation as it develops. So yes, you need to have a strategy and stick to it in a way. Nevertheless, you need to be able to react to the situation as it develops. So agility is definitely important. So what we're not so keen on is really the opposite, which is in a combination often some things that makes us decline an opportunity, meet two opportunities, weak IP, long or unclear timelines, a crowded competitive situation where it's hard to see the differentiating factor, small markets, regulatory mess or unclarity where you really don't know whether you'll be able to get across the goal lines from a regulatory perspective. Massive capital requirements, we see that sometimes, and again, if we can't get the capital together, then the risk is too high, and inflexible founders. So just linking it back to what Jonas was saying, how to interact with investors. I think that very often times when you get a reject, I think that often you don't need to take it as a reject, but as a no at this point in time, because what you often can see, and we see this, is that we like to track companies and we like to see them develop and getting these different factors into place, and something that is sort of a no thank you at one point in time can often turn to a yes at a later point in time. So I would say rejection I would always say as a no at a certain point in time. So definitely, as Jonas said, it's good to stay on good terms with all investors you meet, and keep a good relationship and keep them updated on what you're doing. It can definitely change the situation later in the process. So just rounding up with how to get in touch with the VC, and that's typically not that difficult. All the contact information is out on the web. You can see our website there. Easiest way is to email us. We have a process on how to deal with incoming deal flow. So we will look at your proposal and get back to you. And usually, we're out there at conferences like this, meeting people a lot. That's a big part of our job, just meeting founders and companies. And obviously today this is converted to virtual settings like this, but nevertheless a good way of getting to know. investors and for us to meet companies. So yeah, that was my thoughts.
Thank you very much, Ingrid. And it's a good thing to know also for the companies that you are also an entry point for international syndicates of investors, which can broaden the investor base also for the next rounds for capital increase. So thank you very much.
Thank you.
And the last speaker before our 15 minutes break is Birgitte Gangmark Vilmo from Investinor. She's a business development manager, and the title of her, she's a senior associate, and the title of her talk is Healthcare Investments at Investinor. So,
yes, thank you, Hanne Mette. I'll go right ahead and share my screen here.
Perfect.
Yeah, so first of all, thank you to the Life Science Cluster for inviting us back this year. Last year it was my colleague Daniel that presented our forestry investments. And so this year we'll be focusing more on our healthcare investments, which has become a substantial part of our portfolio. For those of you who don't know Investinor that well, we're fully owned by the Norwegian Ministry of Trade and Industry. That being said, we invest alongside private investors, and we have the same type of return requirements and focus on exit. Currently, as you see here, we have about 8 billion NOK under management in what is an evergreen structure, of which about 5 of those are invested directly in companies. Our current portfolio is 70 plus companies. A big part of the reason why Investinor was set up was to help fill the gap in terms of private capital in the venture segment in Norway. And so we're proud to say that we invested 27 billion together with our partners during the last decade, and accounted for 1/3 of all VC investments during the same time period. So we're by far the biggest player in this market. It's not important for us to be big. That's not necessarily a healthy sign for the market, but it does say something about the role that we play. And also we have now we're accumulated positive returns after having a few recent years that were very strong, and where healthcare has actually been a very important value driver. So a generalist investor, a bit of a focus on certain sectors. We're big in tech and healthcare, where these are probably the 2 sectors where we've been the most active the recent years. Initially, we didn't have the mandate to invest here, but we have had that since 2013. Also have a significant exposure to energy, forestry, as I mentioned, and also marine and aquaculture. In terms of stages, I'd say that's one of our strengths. We've had added flexibilities. Now we're investing both in pre-seed, seed, venture, and growth equity stages. Focus is still on the venture segment in terms of invested capital. That's where we have the most exposure. But we also built during the last 3 to 5 years significant seed portfolio. So in terms of number of investments, that's also a large portfolio. And then Hanne Mette wanted me to go through some of the changes that has been occurring in Investinor during the last year. And so this is a pretty text-heavy slide, so it's not for you to read. But I think what's important to know is that we've gone from being a direct-only investor in companies to having more flexibility. So 2 things happened in 2020. One thing was that we were handed responsibilities from Innovation Norway in terms of administering their pre-seed and seed funds. But also we were, as part of the rescue package, allocated an additional 1 billion NOK to put into a new mandate for fund and matching investments. So this means that today we're both a fund investor and investor in companies. Investments in companies are still the bulk of what we do, but we're building sort of the fund investments part as well. And then there's this distinction to be made between matching investments and direct investments. Typically with matching, we lean more heavily on our co-investors to qualify the case. And so our assessment is really just as much qualifying the co-investor as the case itself. They're responsible for the DD and typically work as a lead investor. And we use this tool at earlier stages, smaller amounts. And then direct investments, still what we do, we put the more or the most capital to use. So it's typically a bit later stage from seed on. And we have the option to be active investors in both cases. With the direct investments, we always take a board seat and work very actively with the companies. And then matching investments depends more on the case and the co-investor involved. Yeah, I won't go too much into the team, but we're investment team of 26 people, based both in Trondheim and in Oslo. On Tove up to the left here, she heads our healthcare team, and she's been very central in building our healthcare portfolio from scratch the recent years. And then it's also me, we're sort of the core team, healthcare team, but we've been adding more team members as we've built the portfolio, and today we have quite a bit to follow up on, so it's been helpful getting more team members on board. We have actually made a conscious choice not to build a very specialized healthcare team in the sense that we don't have people with medical backgrounds or PhDs in the team. So we typically outsource any scientific, technical DD that we need to do. And our strengths lie more in evaluating the commercial aspects of a case, challenging development plans, the strategic choices, building or making sure that the team is right for the current stage of the company. Obviously helping with fundraising, and it's very important for us to be a collaborator in terms of attracting capital to our portfolio. And so we're proud to say that we probably have what is Norway's largest network in terms of professional VC investors. I think in the Norwegian ecosystem, we probably work with most of the players, both in the seed stage and the venture stage. And then also big focus on attracting international capital to the Norwegian market. So you see some of the names here to the right that are on the cap table together with us in our portfolio. And I think for the healthcare team, this is a big priority in 2021. We're spending a lot of time marketing our portfolio to international specialist investors. And I think what's positive here is it has become easier. So there's greater interest in Norwegian deal flow than there used to be. And then I'll just say a bit more about what we look for in healthcare. It's going to be very, very similar to what, for example, Ingrid talked about. We have a very opportunistic investment strategy. Because we are who we are, we're restricted to Norwegian deal flow. We don't have the luxury to specialize in certain areas. And so we have exposure to biotech, to medtech, and digital health. That's our main categories. We have an investment in diagnostics, which you could argue is its own separate category. We're invested in a CMO and in a production company. So what really matters to us is just investing in science or innovation that comes from, a group or cluster that's world-leading at what they do, and them showing that they're solving a problem or meeting unmet medical need that can really serve a global market. And so for us to see the return potential that sort of warrants the type of risk that you would be taking in this segment. In terms of stages, as I said, we have the flexibility to invest very early. We tend to prefer for biotech at least having the preclinical efficacy data, although there's been exceptions to that. Sweet spot is probably getting closer to the start of the clinical program. MedTech sweet spot would be 0 to 2 years before CE mark or launch. That's probably moved a bit to the right for us. So getting closer to market launch, and then digital health, a preference for revenue generating companies. What's really important for us is, and what Jonas really sort of hit the nail on the head when he said that it's about risk reduction. So for us, it's important that the investors or the companies early on present us with a plan for, future value inflection points, future milestones, and being able to sort of tie a realistic capital need to that, because we want to see not just assess the technical and commercial risk, but we have to spend a lot of our focus on the financial risk as well. And that has both to do with sort of the properties of this sector, often large capital needs, and you need to be a patient investor. And so we need to know that we have those kind of co-investors investing alongside of us. But it also has to do with who we are. Invest Norway is restricted to taking 49% of each round. And so we want to make sure that we have funds that has the same kind of horizon and patience as we do. Yeah, just a few quick observations here on our deal flow. It's been steadily increasing, and last year we screened about 75 cases, which was 1/5 of the total deal flow at Invest Norway. And interestingly, to the right here, you see that the mix has actually changed from being very biotech dominated to now being more medtech and digital health dominated. That doesn't mean we're seeing less biotech. There's more cases coming in. It's just the mix or the relative proportions that have changed. Just a brief look at our current portfolio. So today it consists of 19 companies. We do think it's probably one of the largest, if not the largest portfolio of this kind in the Norwegian market. We've been adding a lot of companies the last few years. So when I started 3.5 years ago, there were probably 5 or 6 companies in the portfolio, most of them biotech. So we spend a lot of time sort of building the portfolio, gradually adding more stages, so moving more to the left with more early stage investments, and just diversifying also in terms of segments. And 2020 was a very active year for us, so we did 6 new investments. ARCS, which just presented, is our most recent one. We invested in all of these 3 categories. And that means 2021, well, we're approaching full investment capacity, not so much in terms of capital necessarily, but in terms of resources and what we managed to actively follow up on. So that means we're not closed for new business at all, but we'll be very selective this year. But we still like to hear from companies and get to know new companies. We're screening new cases every year. Or every week, sorry, but yeah, if we decide it's not the right time in 2021, still get in touch with us, and we do like to follow cases 1 or 2 years before we decide whether it's the right timing. So ARCS was an example of that, where we actually got in touch with the company first in 2018, so it took us about 2.5 years before we actually made the investment decision. And then Mette just challenged me to say something about what we observe in terms of gender balance in the sector. And this is something that Invest Norway measures throughout our portfolio. And our goal is obviously to be here 100% in terms of portfolio companies with women represented. And we're not there yet. What we're seeing for healthcare is actually much better numbers than for the rest of the portfolio. So it's our experience that in this sector is sort of leading the pack. And it also helps actually that in Norway, the investor community and the specialist funds are well balanced, if not even female dominated. So that helps numbers in terms of active owners being women and them joining the boards. And then I'll just finish off saying a few words about Calliditas, which happens to be a female-led company, and which is our biggest success so far. So this just illustrates well how Invest Norway operates as a direct owner in companies. This was a company where we were active from day one on the board, and we worked very closely with both management and our co-investor, main co-investor being Industry Fund, throughout the lifetime of investment, and invested substantial capital, close to 150 million NOK. And it was not a straight line to success, and it was a very good exit for us with 500 million NOK in capital gain. But it required, a lot of work and patience underway, and that's what we see as one of our strengths. This has been a very good story for us, and it has only sort of increased our risk appetite in the sector. So we have a very positive outlook still on healthcare. And with that, I say thank you for your attention, and please feel free to get in touch with us. Happy to take meetings. Thank you.
Thank you very much, Birgitte. And thank you also for the overview of the changes that have been in Investinor the last year. I think that's very useful information for the companies, because we know that things have happened, but not exactly what the changes are about. So thanks again. Nils, I would like to welcome you to talk about how to structure all the information that you need to share with your investors. And from my own experience as CEO of several companies, I remember the days of having a hired-in CFO for hire, which, by the way, was excellent, and an Excel sheet and Explorer or folders in an Explorer system, and where you either brought this information with you from time to time or from company to company, or needed to start from scratch each single time. So learning about admin control and what you have built up as a database, which is both quite impressive to start with, and also has the opportunity of learning from case to case, and also expand so that companies in different stages can have access to information and continue building in the same data room. So without revealing all your secrets, welcome. Nils Rydning-Mørk from Admin Control. You're a business development manager, and the title of your talk is Prepare to be Scrutinized, How Proper Use of BDRs Assist Company Development. So please, Nils.
Thank you, Hanne Mette. Well, I think the time is about 11:47, and right now thousands of users are logged into Admin Control, and they're completing hundreds of processes that we facilitate each month. Let's see if I can get my slides to work. Hopefully you will see my slides now. While you see some of the key details about us, I might tell you what I do at Admin Control. I've been with the company for 3 years. My job is basically to communicate with our clients. In that dialogue, there is generally two main subjects. It's the customer's needs, and it's our solution to those needs. Our solution have been developed in dialogue with the advisors that our clients normally engage, that being legal firms, corporate finance, and private equity professionals. So in the audience today is all the different groups that I spend my time engaging with. So my goal in this short talk is to go through some situations that our clients find themselves in when they ask us to assist them with sharing confidential information. For the company executives out there, I will show you how using a data room continually can aid in the company development. And for the advisors, I hope to highlight some functionalities that might make the process of due diligence smoother and more effective. So let me introduce to you the vessel for that exploration, and that's a guy I call Shane Shark. As you can see from his face, that has an eerily resemblance to mine. He is an imaginative and conscientious person, and on top of that, he's really good at sales. So last year, he used his know-how of the fish farming industry to start a venture to process fish carcasses into building materials, which he believes will turn a profit after he has perfected his method through some research. As many startups, he has limited administrative support, but his accountant and auditors sort out the financial reports, and he has some experienced board members that can help him out with advice. But mostly, he has to trust himself with organizing and storing securely the financial statements, end-of-year reports, IP documentation, HMS plans, general business plans, employee contracts, board protocols, and so on. So his first challenge might be to get an innovation grant to finish his initial research. He will be asked to provide budgets and information about his intellectual property. And since he has stored away the documentation in different locations, he is not sure if things are up to date, and he emails back and forth with advisors to get everything checked. He is aware that a lot of the information is sensitive, in the sense that his business idea needs to be protected, but also in the GDPR sense that it contains sensitive personal information. So every email he sends and receives with attachments or with questions regarding the documentation is a small risk. Disregarding the limitations GDPR sets for use of email for the time being, just the risk of sending IP information over unencrypted email is really not recommended in our view. Without encryption, the contents of the email is accessible during transmission, and setting up end-to-end encrypted email is possible, but it requires that both the sender and receiver has to agree on a common encryption standard and public keys beforehand. And we believe that that's not a viable solution in a fast-paced process or with new contacts. So what is our solution to this? If he had a data room, he could easily delegate uploading rights to his advisors, accountants, and so forth, and delegate the responsibility to keep things up to date in a central depository. In real life, it would look something like this. And that is one of our data rooms. If he had a question to one of the documents, he could get answers from his team through our secure messaging function. The document, question, and answer would not leave the encrypted data room. When he has gathered the requested documentation, he can share it with the intended authority, either by giving them access to a limited folder in the data room or create an encrypted export of the combined documentation. So looking at the screenshot from before of the folder structure, some might have thought that Shane did a really good job at organizing his information. Well, he had some help. He used a tool we added last year, which we call the folder wizard. These are template folder structures based on industry standard request lists. So it would take Shane just a few clicks to establish a folder structure for his need, and there are several different templates to choose from, depending on the use case in question. And I might add here that many of the advisors you've heard today, they would probably have the request list that you needed, or they could send it to you. So let's move on with Shane. Let's say he gets closer to a market launch and he needs some funding, or perhaps just some contacts and is looking for investors. His potential investors will want to do their due diligence, inspecting all the aspects of his company. Since he has his data room set up, all the information is readily available. And because he has populated it based on a professional request list, he is conscious already of all the different lenses the company might be evaluated through. So that makes the company more professional. So the talks with potential groups goes along, but in the due diligence process, he does strategically not want all the potential investors to be aware of each other, but still let each of them ask him questions about his documentation simultaneously. So how does he do that? All he has to do is take care of user access. In his data room, he creates a new user role for each potential investor and their advisors, and he gives each group access to the correct folders. He communicates with each one of the user groups in our Q&A module without them seeing each other. When the process is over, he can easily export the relevant data, Q&A history, and usage reports, and send an encrypted copy to his counterparty. So these steps that I mentioned now, getting the investors in, is very similar to how we want to use the data room for a transactional due diligence with one or more counterparties. The key here is that holding the data in a secure cloud-based solution makes it accessible at short notice. It makes it easier to keep it up to date and makes sharing it with external parties less risky. I want to mention one specific use case that might be relevant for the audience of this webinar, and that is investor relations. When the shareholder value is tightly linked to the research and development, the investors will naturally ask for frequent updates. At the same time, this information is usually highly confidential. So there are some key features in the data room to consider in this context. And that is the ability to limit the printing and downloading rights of users, the ability to limit printing and downloading rights for specific documents and folders, and the option to have watermarks on documents, and of course, usage and access reports, which is very important for us legally. So that was my short walkthrough. So while I show you there, like how it ended up for Shane Shark, hopefully, I would like to congratulate you all on being part of this great event. There have been many interesting talks so far, I think, and I'm looking forward to the rest of the speakers. Admin Control are represented here with both board portal and data room personnel. So if you would like to have a chat with us, please do not hesitate to reach out. And best of luck with the partnering.
Thank you very much, Nils. This was very interesting and exactly what I would have dreamed of having when I was talking to investors back in the days as CEO of a company. So we look forward to discussing with you going further how we can support companies and structure information in a good way. Let's continue the program. Next speaker up is Tord Fonnevik from the law firm Hjorth, and I'm very happy to have you here today, Tord. You have experience for many of the recent biotech agreements and public listings that have been visible on the Norwegian life science industry arena the last couple of years, last few years, not more than a couple of years. And your reflections and insights from the law firm side will also be very interesting for both companies and investors to learn from cases. You are partner and head of the Department of Mergers and Acquisitions. And the title of your talk is Preparing for the Next Transaction. So, Tord, the stage is yours.
Thank you. Just checking if everything works. Do you hear me now?
Yes.
Yeah, okay, good. So I will try to, hopefully it's possible to share the screen. I have succeeded with that earlier today, so I hope that works. Can you see my screen now? Now?
Yes, now it's coming.
Okay.
Yes, it's okay.
So I will not spend much time talking about Hjorth and our life science practice group, but just a brief introduction about myself. I'm, as you said, I'm sort of heading up our life science practice group together with my colleague Knut Sverre. We were actually planning to speak together today, but 15 minutes is just short enough time for one, so I will do the talking today. But Knut Sverre and myself, we work often together on our assignments in the life science industry. I work primarily with transactions, including M&A, capital market transaction, and sort of collaboration transaction licensing deals, in particular in sort of the life science industry. Been doing that for, I think, 16 years, probably done someplace between, yeah, someplace far north of 100 transactions in the life science industry. So that's sort of my background and experience. So moving over to the topic of our presentation, since I'm sort of a transactional lawyer operating in the life science sector, I have selected a topic that I know something about and that I think is relevant for many life science companies, namely preparing for the next transaction. I think it's fair to say that most life science companies are continuously preparing for their next transaction. Sometimes it's close into the future, sometimes it's further into the future, but at least in my experience, any given sort of life science company would always be sort of in a phase of preparing for their next transaction. Since I'm a lawyer, I like to put things in a structure. So I have sort of grouped this topic into 3 subheadings or questions. So I will just go through them one by one. So the first question we arise here is, what kind of transaction you may need to prepare for? What we're speaking of today is primarily sort of the funding transactions. And what I'm thinking about with this sort of topic is typically a situation where the company has spent the founder's savings, you have exhausted money from your friends and family, you are typically have been provided some public grants as a soft money, and you need to sort of attract larger sums of money to bring your company into its next phase. So what you do then, you maneuver into the capital market, and then you actually have a choice. Or sometimes it is a choice, sometimes it's more like just an avenue you have to go. But there are 2 avenues in terms of attracting equity capital from investors. Either you could target sort of what we can say sort of the passive investors. They are not engaged in taking an active participation in sort of managing the company. Typical situation would be that you engage sort of an investment bank. They use their brokers to call around to people and ask them if they want to invest, but the investor as such has no desire to actively participate in the management of the company. The other avenue you can go is sort of to seek to obtain an interest from sort of a special fund, investment fund. I think we have heard about a few of them in these earlier presentations today. Or you could sort of seek one or a few sort of strategic investors who plan to sort of participate actively in a company. There are advantages and disadvantages by going both of these avenues. If you go for the passive investors, you keep control of your company as a funder to a higher extent. Often the transactions are less document heavy processes. You just sort of issue new shares, investors subscribe by just signing off on the protocol from the shareholder meeting. You will not hear too much from them on a day-to-day basis. They provide you money, but not more than that. If you go for a specialist fund or sort of the strategic investors, they will typically plan to be more actively engaged in the company. So they might give you sort of management skills, they may give you advisors, they may give you sort of other type of strategic resources that may enable you to succeed with bringing the company further in its sort of development. The flip side would be that a typical special investor, they will ask for some special rights in terms of influence over company decisions and sometimes also preference rights to the company's share capital. So that's number one, transaction number one. The second type of transaction that you may need to prepare for is sort of the collaborations, and that is a big bucket, includes a lot of things. It could be collaboration in terms of product development, or it could be sort of a marketing collaboration where you team up with someone to bring your product to the market. And the category sort of includes the smallest type of collaborations where you enter into a collaboration with the research institution to sort of do some product development work for a limited period of time, or on the one hand, and on the other end of the spectrum, you have large collaboration with large international pharmaceutical companies, such as, for example, Vaxibody's collaboration with Genentech in respect of their personalized cancer vaccine program on sort of the highest end of the spectrum in terms of collaboration and licensing agreements, transactions. And then thirdly, you have sort of the exit transactions. That's typically an M&A. You sell the company, you sell all the share of the company, or perhaps you sell your controlling part of the shares. Sometimes that is a planned event. Typically, if you have a specialist venture investor, they go in, invest in the company on the assumption that there will be an exit. Other situations, the exit event could be more unplanned. Somebody knocks on your door, offer you a takeover bid, and you have to decide quickly. So that's heading number one. Then I'll go over to heading number two. So this is the $1 million question. What may give you a transaction on favorable terms? So I'm looking at this topic from sort of the perspective of the company and the current investors of the company. My ambition is not to give an exhaustive answer on that question for all companies, but I think there are some general statements that you may give, and I think many of these, many of the details in this answer has been addressed earlier today. But for me, if you ask me, in my experience, there are three things that gives you the good transaction. That's number one, it's obvious. It's the quality and value potential of your products or services. So looking at this from the perspective of the investor or your acquisition partner, they are in this to get return on their equity investment. So they are sort of concerned about what you can call the equity story of the business. In brief, I think you can decompose this topic into sort of three basic questions. Number one, what is really the value potential of your technology or products or services? That's about what is the market for the product, how valuable is it, what kind of prices can you achieve, how does the competitive landscape look like, etc. Second question is, well, what kind of milestones need to be put in place to unlock this value potential? And the third component of that test would be, as I see it, how likely is it that these milestones will be met? So altogether, that sort of sums up what you can refer to as sort of the company or the business equity story. Second thing has been mentioned by many today, and that's sort of the quality of the team. Well, one of the investors that I work most with, he tends to say, I don't know if he really means it, but he says that if the team is good enough, I will give them money, and then I would look into sort of the quality of the technology, but that's not my main concern. I invest in people, and I think good people can make good business. So if the product is good enough as it is, I'm pretty sure that these people can create even better products. I don't know if that's sort of that's the main rule, but I think many have pointed on to that earlier today, that the team is really important, and the quality of the team is really important to get sort of equity investments into the company. Thirdly, be prepared for it. In my experience, looking into the situations where sort of a seller or a company have left values on the table, I think 9 out of 10 that could be blamed by sort of not being well enough prepared. I don't say that you sort of lose out of every opportunities if you're not prepared, but I think you lose out of some portion of the value in the deal if you sort of are not prepared on the sell side. So next question in my list, how may you prepare for the next transaction? And I will go pretty quickly through it. It's just sort of a check the box list. This is what I would speak with sort of my clients about if we're planning sort of to make a transaction. Number one, make sure that you're developing your business according to your plan. And the reason why is when you ask the question, how likely is it that this business will succeed in unlocking its value potential? The best proof you have is their ability to meet their business plan as it currently looks. If you have not been able to meet the business plan as it stands today, well, that is sort of some way of proof that there is an increased risk that you will not be able to meet your business plan going forward. So just to be sure that you're continuing sort of your own milestones in the pace that you sort of set for yourself, that would be a valid selling point for investor, and that's at least my experience. The second is consider the need of improving your team. If it's true that the team is sort of a criteria for triggering investment appetite, well, I think it's always good to have sort of a look at your team and see if you can do something, change board members, get more skills into sort of the financial functions, etc. Thirdly, and this is, I think, maybe one of the most important topics on my list, consider the need of improving your ability to articulate your equity story. And what I mean, moving back to one of the former topics, is that an investor will ask, what is the value potential? What is it required to unlock that value potential, and what's the likelihood to succeed? Well, if that is sort of well articulated, it could be very convincing. You can have a very good business, but not being able to articulate the equity story well, and you can sort of miss out on opportunities. And sometimes you just get one chance to speak with the investor, and you should probably be well prepared to make your equity story as clear and as attractive as possible in that particular opportunity event. Fourthly, on my list, seek to avoid material due diligence findings, and this is an easy one. If there are discovered material due diligence findings in the midst of a process and you're not prepared, often that will create less favorable terms for you as a seller or as a company issuing new shares. In the preparation, what you can achieve is, first, you can identify things that are adverse. You cannot do anything about them, but you can prepare and take them into account in presenting your sort of equity story. You can take account for the risk or the adverse events, so you have taken it up front, and then sometimes you can actually fix it. But it's hard to fix it just in the midst of a transaction negotiations. That will more often lead to sort of adverse terms for you as a seller. That is my experience. The fourth thing is select the right advisors and partner for your transaction. If you're doing a private placement in the Norwegian market, there are just a few usual suspects among the investment banks. If you're doing an international transaction, or if you're looking for a specialist investment fund, maybe there could be other financial advisors, not Norwegian investment bank, but perhaps some specialist advisors outside of Norway. You need to appoint lawyers, and some of them are experienced in these type of transactions, and some of them are not. Sometimes you can sort of use sort of a more general counsel because there are no sort of special features in the deal. Other times you would need to sort of step up, or maybe you need even to engage foreign lawyers. If you're doing something in the US, for example, you should probably go for a US law firm to help you. The last topic is on my list is make sure that you're aligned with your key stakeholders. Two examples. One, if you have a large shareholder group and going into a transaction process, I would normally recommend that you get yourself a mandate to the transaction lead, if that is the board or the CEO or whoever. Often it's complicated to go back and anchor positions often in a process if you have a large shareholder base. The second topic I would like to raise is to make sure that if you have some strong, active shareholders in your company, even though they are not controlling owners, generally it makes sense to keep them happy. So if you're doing transactions that really have an impact on their sort of expected interest rate return, etc., just make sure that they are involved and sort of keep your process anchored with that type of investors. This was sort of the very short and quick and dirty run through. I have some years ago published an article about acquisition of technology company. I go much into details there. So if anyone wants to read, please do so. We are available, Sverre and I, if somebody wants to speak with us. We are available at phone and email. We take meetings, and even though we are lawyers, we do not bill for getting to know people. So everyone who wants to get in touch with us, please do so. I guess this presentation will be shared with anyone, so you have our contact information, and we have also added a few sort of foils just showing what we do, some selected transactions that we've been involved with, so you get sort of an impression of our experience and capabilities, should you ever want to seek our advice on your own transactions. So I think that was basically what I had on Mette.
Thank you very much, Tord. That was very valuable insight from a number of transactions and some structured learning across cases also. So thank you very much. The next speaker is also representing a law firm, Sands, who has also been an active member in the cluster and supported our members with various webinars and physical meetings when that was possible on raising the awareness of important topics. So today we are happy to announce Åse Gundersen, who is a special counsel from Sands. And the topic of your speech, Åse, is From Research to Revenue. What are investors really looking for? So please, the stage is yours.
Thank you. And thank you for this opportunity to meet, even in this virtual setting. It's always good to see other people in these times that we all spend so much time at home. This is one of the creative the development of creativity during these difficult times is that we all, as always, find new solutions to new problems. And this is really what my little speech here is going to be about. I'm addressing the type of companies that are common in the life science sector, although not every company is an R&D company, but my focus will be on the research results as a business case, and I will look at how to get from research to revenue. Oops. So when you're meeting your investor for the second time, you have already met them, you have sold them your ideas, they want to meet you again, they have ticked off on some of the main criteria they have on their list. Now they're looking beyond your brilliant ideas, they're looking to identify whether this is an investment opportunity. Unfortunately, for those with the brilliant ideas, that is not enough and not even always the most desirable object from an investor perspective. What they do want is technology that works with solid IP position from which to generate revenue in not a too long perspective. So in order to identify an investment opportunity out of a research case or a research results, you need to turn from the actual research and invention aspect over to the commercial aspect. How can this invention or new technology actually make a business case? There is a legal aspect to this, which is the main topic for my speech, which is that the investor will now seek to identify the obstacles and risks that have to be mitigated on the way from research to revenue. It's three aspects of this that I'm going to address. And IPR, intellectual property rights, is key, and I will talk quite a bit about IP and how to both protect and exploit the full opportunities of IPR. But IPR is not enough. It's also the contractual rights and obligations attached to the IP, which is going to be subject for much scrutiny from the investor side. And thirdly, they will be looking at freedom to operate. The IP is good to have. It's only worth its value once it can be put into operation. And that is a question you need to address early on, not when you're at the step of the market. So solid IPR. This is not going to be an IP lecture as such. So just very briefly, it's one of the first questions that investors will ask. Do you have IPR? What IPR do you have? Is there a patent? Normally, at this stage of development of your invention, of your company, you won't have perhaps a patent granted. You may have patents pending, and that is something which is often sold in to the investor as if it were solid IP, which of course it isn't until a patent actually is granted. But a patent filed is proof that there has been the product or the invention or the technology is developed to the point that the patentability requirements are considered to be met, and a patent is filed. And therefore the patent pending is actually the IP that you have to sell, and you have to convince the investor to accept as the IPR at this stage. Just briefly, also, there are other types of IPR, obviously, design, copyright, know-how, but as any IP, it has little value if it's not solid, and that's what the investor will look at very thoroughly when you get to a due diligence process. But even at this stage, which is the stage between your sort of first pitch and the seriousness of a due diligence process that is started, this is how you invite your investor into the due diligence process, and you must give them an idea of what they will meet there. Yes, very briefly, I mentioned that non-patentable technology, investors everyone will look for patents, and it's considered to be the state-of-the-art IPR. But non-patentable technology can also be protected. There are various types of IPR as copyright, database, even a registered design, which protects the form and not the function, but it can be a backdoor into creating exclusivity for a product that cannot be patented. There are examples of medical devices that have been where the actual form of the product is registered as a design, and thereby protecting a space for the product itself. There's also the possibility, and this is really an alternative to patent, to treat your know-how as a trade secret and actually obtain legal protection by law. There is a new law on protection of trade secrets. It has to meet certain criteria, and it's really something that you need to be have a plan for upfront, rather than look into as a second choice or plan B once you see that patent strategy has failed. An IP strategy based on protecting trade secrets need to address the criteria of that from the beginning, which obviously the main focus will be on actually keeping the secret, but also in identifying what type of know-how can be defined as a trade secret. When it comes to patent filing, timing is everything, and this is where many startups fail, because they stumble towards the finish line that they think is the patent filing, and they get so eager in a way there that they may have actually spoil their own chance to get there once they do knock on the door of the patent office. There are 3 requirements to patentability. There's the novelty requirement. The invention has to be new in comparison with everything that is known in the public space. There's the inventive step requirement, which means you will have to wait for the invention to reach its full potential before you file. If you only have, if you file when the invention is 80% complete and your patent application is rejected because of a lack of inventive step, well, you might have been successful if you had waited until the last 20% was in place. There is the industrial application requirement, which also means that it's not sufficient for a patent application to succeed for the technology to work in a sort of laboratory setting. You have to prove that it does have industrial application and that it actually works. And all of these criteria you will see have sort of different meanings in relation to the timing. The novelty requirement is the one that is at the forefront of the attention, and rightly so, because it's very important. The novelty requirement is very, very strict, and it's therefore extremely important to file the patent application before you start any type of disclosure of the invention. There is a great risk of self-sabotaging here. If the presentation, if your technology is presented out there before filing, you may have lost the opportunity to obtain a patent. And the presentation of your ideas, the presentation of your inventions is actually what you have been doing from starting to build your company. You will have been out there trying to attract interest from industry actors, you're trying to attract interest from potential partners, and you are, as now, trying to obtain interest from investors. But it's this is a slippery slope to ride, because you must ensure that any presentation you do give does not prevent you from meeting the novelty criteria when the patent is actually filed. This means that it's generally advised to file the patent application prior to entering the stage where you do offer presentations on a general basis of the technology. But the timing will also require you sometimes to do present prior to the patent filing, and that's when the non-disclosure agreement is crucial. There shall be no disclosure before non-disclosure, no disclosure before an NDA is in place, and the NDA needs to be solid, protecting very, very tightly the information you give about an invention that will be subject to patent application in the future. Another aspect that comes with a lot of pros, but also some cons, is collaboration and partnerships. Very common, of almost always the case in research and development in the life science sector. It will be a key success factor in many cases, but it also is a red flag, because you then enter into a number of contracts with many people, institutions, other types of companies or environments out there. And any contract you enter into will create and assign rights and obligations. And the investor obviously is looking for unfettered rights in the IPR that is the end result of this collaboration. And therefore, any and all third-party rights is a big red flag. An unresolved third-party right is often a no-go. This is a showstopper for many potential transactions and investments once the due diligence process comes to the stage where you actually have to tick off, are you able to deliver clean and unfettered IPR free of the contractual strings with all the contracts you have entered into along the road, be it joint ventures, be it R&D cooperation, be it license agreements that you license in and out. So in any collaboration and partnerships that you enter into at the early stage, and that is going to be key to your success, make sure it's not a stumble stone for the end success. Ensure that in the contracts you enter into, you get what you want, but you also keep what you need. I will give you one example just in a moment, but I always also want to say, beware of the first customer trap. For all startup companies, it's very exciting when the first customer knocks on the door. Often it may be a company with whom there's been some kind of cooperation in the final stages of developing the product and getting it ready for market. And the excitement around having established contact with the first customer that's going to help you, enable you to actually reach market, may blind you a little bit in relation to what you actually give away in a contract with the first customer. So
you have 1 minute left.
Okay. Just very quickly then, I will give you the example that I did mention with a collaboration. There's some particular do's and don'ts in relation to collaboration with academia. Basically, the novelty requirement of patent applications sometimes go against the role and purpose of academia, which is to generate knowledge and share knowledge and enable it to be developed further. The professor will want to publish, but doing so may disclose the invention. Yeah, I'll stop there. I'll just very quickly then go into the freedom to operate, which is the third very important part of this landscape. The investor will want to ensure that the technology can be made, sold, and used without any third-party patents stopping it in all relevant markets. But they also want to see that you have created a space for which your own IP to grow into. The freedom to operate from a contractual perspective, I have mentioned. From a legal perspective, it's the identification of the patent landscape and ensuring that no third-party IPR may obstruct your market access. You certainly don't want to risk litigation, timely and costly, to prevent your entering the market once you are at the gate. And you do not want to risk litigation with claims for damages once you have successfully reached market, even though you may be in the right, but 10 years of litigation to prove it may not be worth it. From a business perspective, a freedom to operate analysis is a way to create a garden from which your IPR will grow and develop. So you do not just look at freedom to operate analysis from a defensive perspective to make sure that there are no IPR that may prevent you. You always also look at the freedom to operate analysis as a tool to create business opportunities. Many inventions that are patented are not really inventions at all. They are the result of a careful patent landscape analysis that have discovered a white spot. And to file a patent in a white spot may not require a great invention. It requires the ability to describe something that is able to fill that white spot and grant a patent rights. So all of this is interlinked, and to protect the investment opportunity from the start, you need the IP strategy from day one, you need strict non-disclosure obligations from day one, you need IPR to create as well as to protect the business opportunities, and as I said, no contractual strings attached to the IP that is the result of both your own research and the collaboration you've had along the way. Thank you for your attention, and sorry I went a little bit over. This is our team, part of our team. I'm special counsel at SANS, working with IP and life science in particular. Katrine Malmö-Høvik is our head of IP, and Andreas Fuglesang is our head of M&A. And we've had the pleasure to work with the life science cluster for a long time, and we'll continue to do so. Thank you.
Thank you very much, Åse. And thanks for sharing your broad experience and your reflections. Now we are heading to the last presentation of this seminar, and I'm very happy to welcome Jonathan Gertler and Vasilios Kofitsas from Back Bay Life Science Advisors. And I look forward to hearing you giving us the international perspective. You also have a broad background and experience from a large number of processes, both on the buy and the sell side. And I always think it's good to have someone from outside our sandbox just to check whether we have started creating an echo chamber and being agreed on everything. So until you start becoming part of our echo chamber, at least, I'm very happy to have you giving us the international perspective. And you all only have 15 minutes. So I would like to also tell that this is a teaser to a seminar that we are planning together with you later in the spring. So for those who see more interest in digging into this topic, we'll keep you posted also on that part. And title for your talk is Going Global, an International Investor and Investment Banking Perspective. And Jonathan, you are co-founder and managing partner and CEO of Back Bay Life Science Advisors, and Vasilios, you are managing director for the investment banking division. So please, the stage is yours.
Thank you very much, Hanne, Mette, and delighted to be here. We work extensively in the Nordics, and so although we are hoping today to provide an international perspective, we also want to make sure that we are recognized as honorary members of the Nordic community, because we certainly have many dear friends and colleagues with whom we work. I'm going to wear a hat today that is primarily that of an investor hat, because I'm also a managing director or partner in a growth capital fund based in Boston, again with global perspective and global reach, and my partner of many, many years. I'm really one of the nominal co-founders as well of Back Bay. Vasilios Kofitsas will probably focus more on the investment banking and preparation side. So with that, I'm actually going to turn it over to Vasilios from Back Bay, as I am as well, of course. And we'll kick off and hopefully bring this home within 15 minutes. Hanne, my stopwatch is indeed on. So.
Likewise here. Hello, everyone, and good afternoon. So we'll go through a few slides here, and really having more of an open discussion rather than reading bullets. And a lot of the topic here is what do you do after you have an investor on the hook? But the answer really starts from the beginning, before you start making your calls to investors. There's three areas here in prep, putting together your funding strategy, and of course, setting expectations for yourself internally and your stakeholders. So preparing for outreach, I mean, it's really understanding your story. What is it that you know? Are you able to articulate it in a timely manner? And Jonathan will certainly touch on the investor aspect of it. But it's really understanding what you have and how you position it, but also understanding where the gaps in your story currently are. So for example, understand what the physician community and the key stakeholders in the medical community are saying about your profile, your assets. During the diligence process, which we'll touch on later, your counterparties, your investors are going to be talking to the same folks. So you really need to understand how the community feels about your product offering. There's clearly going to be gaps in your story. And it's important to understand those, not only to see if you can resolve them before you begin your outreach, but if you can't do that, how do you position that and how do you control that discussion when you do go out to counterparties? For example, regulatory, right? You might not have had any interactions with regulatory agencies, but you need to at least have a position on your strategy and how you're viewing the interactions and how you're planning for them at the current time. IP is another one. You may not have filed all your IP yet, but you need to have your strategy in place before going out to investors or frankly strategics in an M&A or licensing setting. Get your information flow ready as well. And this is the physical documentation, right? Everything from corporate documents all the way through to any market research, financial modeling ready. We'll get into diligence a little bit later, but it's important to be ready because your counterparty is really going to dig into the weeds on this one, and you want to be proactive and not reactive when it comes to that. There's also a list of, I guess, for lack of a better term, of intangibles, right? Decide what you want in an investor and beyond just the money. What kind of a profile of an investor, and again, Jonathan will get into that a little bit later. Be prepared to hear not interested. As compelling of a story as you may have, it doesn't always fit the profile of the other side. So be prepared for feedback that doesn't really go your way. And finally, be flexible. Be flexible in how you tell your story. Be flexible in addressing and dealing with investors. And we'll get into valuation in a little bit, but it's not a cookie cutter approach. You need to really cater your story to what the counterparty on the other side really needs and how they view investments at this point. So with that, Jonathan, maybe turn it over to you on when it comes to funding strategies.
Sure, and thanks, Vasilios. So I want to make a couple of points, and I also want to tie this again to the basic premise of this talk, which is that you have garnered interest. I think everything that Vasilios has said is extremely important because you will only garner interest by demonstrating preparation. But let's assume, for purposes of my section of discussion here, that you're in the room with investors, you've sent out a teaser, you've been introduced, etc., and actually interest has been expressed. And so you're going to be having that meeting, and what are they going to look for? I'd like to make a couple of personal comments with regard to the way companies are perceived, and I'll state as well, in addition to the introductions of me that have been made, I've also started 3 companies, one of which has exited, 2 of which are in process, one a biotech and one a health tech. And it is really one of the most unbelievably frustrating processes in the world to raise capital. There's probably nothing more onerous, and it's for all the reasons that have been mentioned. One is that investment groups have a mandate. Their job is actually to return capital to the people whose capital they're managing. So it may not fit what you're doing, regardless of how interesting it is. And it can be really, it can be disappointing to hear that over and over again, but you have to realize that capital has to match investment style, has to match your company and your strategy. One of the things that I actually appreciate very deeply about the Nordic region is that I think there's a greater intrinsic modesty and collectivism than there is among American entrepreneurs in certain American sections. And I say that with just tremendous positivity. One of the things that as an investor, we come across are management teams that have not done their work, but won't admit it, won't necessarily demonstrate modesty around what isn't known and can't be known by an earlier stage company. And I want to emphasize there's no shame in saying we don't have that information yet, et cetera. The mistake, though, is not setting out to get it or at least trying to contemplate it. And that is where I think companies get tripped up in these first meetings. So coming in at least with some degree of preparation, as Vasilios has outlined. To be very specific about this first meeting, there are things that investors really want to know. They want to know that you know your space extremely well, and also that you know it not only in the areas in which you've been testing your world, and whether that's health tech or biotech or med tech, it doesn't really matter. If you haven't addressed how you fit in the broader markets, that is actually a weakness which will be explored and also be a turning point. As Vasilios said, you can't have every regulatory and IP process fully underway, but the strategy needs to be there. But most importantly, is why are you funding? And in that first meeting, coming in there with even an early statement that says, we are seeking X amount of capital to get to this inflection point, and it will be utilized in such a way. And incidentally, the capital is not just the bare bones operational costs of getting there, but it's buffer. It is in case things don't go well, which should be said, because things never go in a straight line. You have to be prepared to buttress that capital. Because there may be opportunities that arise for exploration that weren't anticipated, you need that to buttress the capital. And whether it is, new IP filing or new competitive threats or suddenly a new exploration, all of that needs to be accounted for in the funding raise. There does, to point out a difference between American and European companies, there tends to be a let's just raise enough to get to where we're going attitude among European companies, and an excessive capitalization often pushed by large venture groups whose business model is to deploy a lot of money in the United States. I actually don't think either of those things is correct. I think there's a huge dilutional risk from undercapitalization. So all that buffer capital I just spoke about should be there, but there's an equal risk of overcapitalizing because it can hurt the existing investors in a way that they don't want to see happen. So knowing what you're raising, knowing why you're raising it, understanding the inflection points, defining what the pitfalls are, and coming in there with both a sense of mastery, a sense of global perspective, if not global exploration, but also a sense of humility and willing to listen and being willing to be a partner to the fund is critically important. And I think it is wonderful as an investor to hear that we are seeking you out, not because an intermediary introduced us to you and we got this meeting in a cold call, but because we actually know your portfolio, feel that it's complementary, and truly understand what your investment mandate is. And therefore, we believe we are a company that should meet that. So all of that funding strategy should be there on the front end. We have a few more slides to cover and about 6 minutes left. So I'm going to turn it back to Vasilios for the next part of this one, and then we'll wrap it up on the last slide.
Sure. Thanks, Jonathan. So with regards to valuation, look, this is where we spend a lot of time with our clients before going out, particularly on the M&A licensing front, but it's certainly relevant on the investment front. At the end of the day, and I think I'm going to quote one of my partners, it comes down really to what somebody's willing to pay versus what are you willing to take. We can run all the models there are, but it really comes down to that cross section. So it's important to signal flexibility. Okay, let the market talk to you and not the other way around. We rarely take opportunities out with a valuation, with sharing any valuation considerations to the other side. Of course, internally, it's a different dynamic. You do want to set some precedent and some understanding and have a sense of where you want to be. And you should certainly defend that position when in negotiations down the road. But it's critical to be flexible in how you value your company. Overvaluing certainly has can have a negative impact down the road, and we run into this quite a bit where there was a nice valuation on the table. The company raised capital at that high valuation. But what we've seen many times over and over again is product development is not linear, and by raising capital at a too high valuation, you will put yourself at risk for a down round down the road. 1, 2, when someone comes in, whether it's an M&A or licensing setting, it can scare the other side off. If you're going in too high. At the same time, fully understand you don't want to undervalue your assets when you are talking to counterparties. It's critical that you put the investor hat on when you're looking at valuation expectations, because they're going to look at it a little bit differently. They'll look at it from an exit standpoint. Where is the exit? What are my expectations at that exit, and building your valuation from that standpoint. So again, we're limited on time because we can spend a full hour on this section alone. But the key takeaway here is have an understanding of what you're worth, but be flexible when you're in discussions with counterparties. Let me flip onto the next slide on the outreach.
Yeah, and I will, this is a little bit redundant, so I'll say this quickly. One thing that I want to go back to on valuation is that the victory of a high valuation at the early stage does not translate into a victory at the end stage. What has to be set up, as Vasilio said, is a win-win for all investors throughout the cycle of the company's growth. And again, never lead with your valuation. If asked what your valuation expectations are, simplest thing to do is to state what the previous round was done at, but also state that it's what the market will bear. Because signaling anything else actually can push people away that will ultimately be on the hook and will be pleased to invest. In terms of investor outreach, the most important thing is to, as a young company, even if you're working with an intermediary, always be the ones that open the door. Identify the investors that are interested in your space, that have knowledge, where you can articulate a reason for why you want to work with them, why it's not just capital alone you are seeking, how it impacts the board that you will put together, and try to make every introduction warm. Don't hesitate to use connections for introductions. Don't hesitate to use board members for introductions, but ensure that you are as informed about the company, the fund that you're interacting with at these first meetings as they will be about you. In fact, even more so that can be articulated. Let's move on to due diligence and finalizing the investment.
Sure. Thanks, Jonathan. And so I touched on due diligence earlier, but again, going back into the prep phase, okay? Intermediaries and law firms have due diligence outlines. Get a hold of one early, build your data room early, and have it ready for investors. The worst thing you can do is be reacting to every single due diligence request item that comes from the other side, and there's going to be a lot, whether it's before a term sheet or after a term sheet. Be ready. It'll make for a more efficient process. And frankly, from a perception standpoint, it really builds credibility among those that you're speaking with. questions going to come quite a bit of them. We were in the process late last year where it was north of 500 questions. Track them all. Make sure you have the question that was posed and the answer, and make that available to not only your team, but also to the other side. The other side has a full team that's evaluating your company, and so a proper diligence tracker is as important as a robust data room. Negotiations and close, again, I'll go back to what I said earlier: flexibility. Be firm, have a position on terms, but listen to the other side as well and what their needs are. Because once you get through the threshold that, yes, they're the right partner for my company, both as mentors and funders, you're going to be on the same team moving ahead. So it's important to be flexible, have positions on terms, and rely on your advisors, but also rely on your advisors when they tell you, look, these are market terms. Let's keep moving ahead. Again, there are many war stories that Jonathan and I can tell in this. The one that I always go back to and invoke is in the fundraising process. There was a client I had that was looking to raise capital, very close on terms on the term sheet. Decided to play hardball on one relatively minor issue, and the next day is when we had 9/11, and so not only did they not get the funding, but it really crippled the company, and the company didn't last that much longer after that. And it's not to scare anybody, but it's certainly a cautionary tale on negotiating and really driving this to a close, because there are things you can't control that can occur. So it's important that you get there. And a question was posed to us: how would anything that Jonathan and I just spoke change if you're running an M&A or licensing process? And I would say very little. Being prepared, it's the same process. It's just your audience now changes from investor to a strategic counterparty, but your preparation is the same. Your outreach is, again, similar, and really the diligence process doesn't differ much. Obviously, from a strategy standpoint, you need to be careful. You don't give away the store, for is a saying that we have here, when you're looking to partner, and making sure that your partnering strategy is in line with your investor strategy. So I think we're up at it on time. You can obviously reach us through our website, where we have a detailed contact information, including phone number. But thrilled to be here and talking with you. Again, it's certainly a topic that we can spend quite a bit of time on.
Yeah, and I'll close with two very short comments. Please feel free to reach out for one thing. And we have two expressions. One is be prepared, which is, I think, the essence of what we've been saying. And the other is to control the debate. Please be certain always that you are so in control of your own information and anticipate what is coming, that even though it is a debate, you are not left in any way blindsided by it. We think you have a phenomenal ecosystem. Hanne and Mette knows that we are very, very much admirers of it, and we look forward to our continued work there. So thank you, Hanne and Mette, for the privilege of talking here today.
Thank you very much, Jonathan and Vasilios. We really appreciate it, and appreciate having you as part of our cluster as well.
No, thank you.
With that, I will say thank you to all the speakers today. Thanks for listening, and we hope you have enjoyed the day.